£60,000. Gone. Just like that.
That's what one family handed straight to HMRC Ho for doing nothing wrong.
Here's the wild part, Hugh.
Just for not knowing 4 simple things.
Legally, no loopholes.
Just 4 boxes, ticked in the right order, before either of you goes.
Most couples never tick all 4.
Not because they're careless.
Because nobody ever sat them down and explained it in plain English.
By the time the first one passes, it's often too late.
I'm not a financial advisor.
But I've gone through exactly how UK inheritance tax actually works in votes, and it's wild. There's a deadline too, Bo, April 2027, and it affects almost every pension in the country.
If you've got a SIPP, a workplace pension premium, you need this. Stick around 4 minutes, and Vineting had 4 fixes. Start with the house. Most couples reckon it just rolls over to the other one, tax-free, when the first of them dies.
They're right, that's the spousal exemption, and it's rock solid. But here's the messy bit that trips almost every family up, Hawan.
The second death. When spouse 1 leaves everything to spouse 2, their own personal tax-free allowance goes completely to waste.
Since nothing got taxed on the first death, that full allowance doesn't just vanish the coulis. It rolls straight over to the survivor.
But stack another allowance on top that most people have genuinely never heard of, to Pestimus, the residence nil-rate band, worth up to...
So when the second spouse dies, there's 2 nil-rate bands sitting on the table, £650,000 combined.
£175,000 per person, and it transfers across too the exact same way if it goes unused.
Put both of those together, and a couple can shield up to £1 million, utowins, house and all cease, from HMRC.
Catch is no, that residence nil-rate band only kicks in if the family home goes to direct descendants. Kids, stepkids, grandkids, greats, nobody else counts. With the wills sorted properly, house going to the kids on the second death, their combined threshold is a full £1 million. Now flip it, Ben. Wills that skip the residence nil-rate band or leave the house to someone who isn't a direct descendant.
Threshold drops straight down to 650,000. That leftover 50,000 gets hit at 40%, 20 grand, gone.
Here's the big thing most families completely miss, that transferred allowance isn't automatic. Nobody applies it for you at all.
Someone has to actively claim it using a specific form called the IHT 402, filed alongside the main inheritance tax paperwork.
And there's a strict clock on it tried. 2 years from the end of the month the surviving spouse actually died.
HMRC will not chase you for this. Miss that window and the allowance is gone completely taid. No appeals, no exceptions.
So the one real question worth putting to a solicitor is whether your current wills fully protect that residence nil-rate band close. Get it in writing. Onto the ISA preony, and this one genuinely catches nearly everybody out, even people who think they've got this all sorted.
Being tax-free while you're alive doesn't mean it stays tax-free when you die. The moment you go, it's part of your estate.
It usually escapes tax on the first death purely because of that same spousal exemption pruple. Leave it to your other half. Say their ISA was worth £7,000 to £5,000 when they passed woes, that full amount becomes an extra allowance, just for you. You get your usual £20,000 plus that one-off £75,000 on top trade, £95,000, tax-free wrapper fully intact. You don't even need the actual investments themselves, Cray. You simply claim the allowance and use it within your own ISA.
There's a deadline though, Kentrit. 3 years from the date of death, or 180 days after the estate wraps up.
Miss that window and the allowance is gone for good, permanently, no extensions available from HMRC whatsoever, full stop.
Widowed in the last couple of years and this is genuinely news to you? Ring your ISA provider today. Most have a process ready and waiting.
Right hang, 2 down, 2 to go. These next 2 come with real-time pressure attached.
Leave that ISA straight to the kids instead though, and it's fair game for tax exactly like anything else in the estate.
Now the pensions came, and if either of you has got a SIPP or a decent workplace pension, this next part really matters.
Pension pots have sat completely outside the estate for years. The payout isn't something you're automatically owed by law at all.
It's paid out entirely at the discretion of the scheme trustees, parketees, and because it's discretionary, it's never counted as part of your estate.
A SIPP worth £300,000, nominated properly, could pass straight to your kids with HMRC nowhere near it, completely untouched.
All of that changes from the 6th of April 2027, a date that's coming up faster than most people realize. From that date, most unused pension pots and death benefits get pulled straight inside the inheritance tax estate, no exceptions at all.
This has been quietly moving through Parliament since late 2025, but it isn't a maybe, it's already locked in and happening.
That same £300,000 SIPP could face a straight 40% bill next April, £120,000 gone.
There's a nasty second layer too, die after age 75, and whoever inherits the pension pays income tax on what they draw.
So you could face inheritance tax on the pot itself and income tax on the withdrawals. Two separate hits on the same money.
The spousal exemption still applies under the new rules though, Teo. Pensions passing to a husband or wife stay fully exempt either way.
It's the second death, pensions going to the kids and grandkids, where this whole change genuinely bites the hardest for families.
Single most useful thing you can do this year, sort out your nomination form, sometimes called the expression of wish.
It's not legally binding, and that's actually exactly what keeps it outside your estate fors. But trustees do take it seriously regardless.
Out of date, pointing at someone who's already died, or an ex from years back? The trustees end up deciding for you.
Ring your provider and say you'd like to update your expression of wish. That alone takes about 20 minutes, completely free and urgent.
Last asset, and it's the pile nobody ever really thinks about, Poe. Current accounts, savings, premium bonds, investments sitting outside an ISA.
Here's the good news, Tades. Everyone in the UK can give away £3,000 a year, completely tax-free, no waiting period at all.
Didn't use last year's allowance. You can carry it forward once, up to £6,000 in a single tax year.
For a married couple, that's potentially £12,000 a year moving to the kids or grandkids with zero tax comeback.
Over 10 years, that's £120,000 removed from the estate before any 7-year clock even starts ticking.
There's a lesser-known exemption too, and it can honestly be even more powerful than the annual one for the right family.
If your pension income covers more than your everyday spending, regular gifts made from that surplus income can be entirely exempt.
No upper limit at all, but the gifts need to be regular, come from income rather than savings, and not affect your lifestyle.
Keep a simple record. The amounts, the dates, the pattern. HMRC may well ask for it further down the line.
Bigger one-off gifts start what's called a 7-year clock. Survive the full 7 years and the gift sits outside your estate entirely.
Die somewhere between year 3 and year 7, and something called taper relief scales that tax bill down gradually instead.
The clock only starts on the day you actually make the gift. One made at 70 clears comfortably by 77. One boundary worth knowing though, T, you cannot give something away and quietly carry on benefiting from it yourself, ever. Hand the house to your kids but keep living there completely rent-free, and HMRC pulls that gift straight back in kind. Talk to a solicitor first if property's involved.
So here's the whole thing in one breath, Bay. A married couple in this country really can pass £1 million to their kids.
Without HMRC touching a single penny of it. Not a fantasy, not just for people with an accountant on speed dial either.
It's written directly into the law, sitting there waiting, available to completely ordinary families exactly like yours right now, today.
4 things need sorting. The will pointing the house to direct descendants, and the pension nomination kept fully up to date.
The APS claimed if it genuinely applies to your situation, and the annual gift allowance actually used year after year consistently.
If you do just one thing this week, stuns, ring your pension provider and update that expression of wish form properly.
20 minutes, completely free and genuinely urgent, with April 2027 creeping up faster than most people realize right now.
For everything else, Hughes, the wills, the gifting, the ISA allowance queues, just pick whichever feels most relevant and start there today.
I'm not a regulated advisor, so for your own specific situation, speak to a proper IFA or an estate planning solicitor.
Or PensionWise, completely free of charge, no catch attached to that whatsoever, available to absolutely anyone who needs it.
Subscribe now to the Tax and Pension Brief UK for expert advice delivered straight to your inbox every week.
Look after each other and get that paperwork properly sorted while there's still plenty of time left to do it.
Which one of these four haven't you looked at yet? Tell me below.